So picking up from what we did the last day, what we're looking at here is I'm just going to focus on the ratio analysis. I'm going to focus on, we looked at profitability the last day. I'm going to look at more liquidity and gearing, and I'm going to correct the homework. I'll correct the homework first for profitability. So again, ratio analysis used to assess the performance of a business relative to its previous years and its competitors. And these are our three headings: profitability, liquidity, and gearing. So profitability, we said there was gross profit margin, gross profit divided by sales, net profit margin, net profit divided by sales, return on investment, net profit divided by capital employed. All three are multiplied by 100 for generally for any percent. Obviously your answer is in percent. These figures are generally given in a question, but as we'll see now with the first one, they may not give all of the figures and we may be required to work it out. These are the formulas. You would have to know the formula. There's a good to high chance that if they asked you to work out one of these in a question, you'd be expected to know the formula at a higher level. But again, there's only 6 of them, and it's they're quite similar. Obviously, gross profit and net profit are both the chosen word divided by sales, and return on investment being net profit divided by capital employed. Homework. This is the question. 2004 and then 2005. Assess the company and how they're doing based on these 3 formulas. So the first formula there we have, and I'm just going to get out of this here just because I'm going to be writing. The first formula we have here is our gross profit margin, which is gross profit divided by sales. Now, where's the gross profit? It's not there. But I told you that this, if you go back in your slides, you'll see that there's a slide here showing the an abbreviated format of the profit and loss account. This is how you'd work it out, your profit and loss. So let's look at this, and let's look at 2004. What figures do we have? Sales, 2004 they were 400,000. Less cost of sales, we don't know. They don't tell us gross profit either. So therefore, I don't know what to take away from sales to get gross profit. Okay, so I'm missing gross profit. That's fair enough. But what else do I have? If you look at 2004, they gave us expenses of 40,000. So I have that. They also gave us net profit of 60,000. So I have that. So once you know that this is your format, you can work out something that you're missing. I have sales, 400 grand. I have expenses, 40 grand. And I have net profit, 60 grand. So if I know my net profit is 60 grand and I know my expenses are 40 grand, obviously I'm able to work out what my gross profit is. So I can work my way back up. In this one they gave us here, if I know the net profit is 400,000 and I know the expenses are 100,000, well, to get there, I obviously would have to have had a higher gross profit. So even if we didn't have this 500,000, we'd know that if this is 400 and this is minus 100 here, then obviously this would have to be 500. This question, net profit is 60, expenses are 40, therefore I know that if I were to, in reverse, if I was to add these together, my gross profit would have to be 100. 100 minus 40 gives me 60. So I can work my way back up. As long as I know this format, I can work my way back up. So I've that kind of briefly just explained here. I just kept it in white font because I don't want you to see everything at the same time. So for 2004, I don't know my gross profit, but as I said, the 60,000 is my net profit. I know the expenses are 40,000. Therefore, in reverse, I know that my adding them together will get me back up to what my gross profit would be. 60 plus 40 is 100. Having looked through the homework, most people were fully correct with net profit and return on investment, but a lot of people struggled here with this gross profit. So that's how we'd work our way back up. You could obviously work your way down or work your way back up. Anyway, I've that explained. So 100,000 is my 100,000 is my gross profit. Therefore, I know that if I put that in now, 100,000 is my gross profit. 400,000 is my sales, multiplied by 100 over 1, 25%. So gross profit margin, 2004, 25%. What about 2005? Well, it's the same process again. I look here and I see, okay, I don't have my gross profit, but I can work it out. Net profit plus expenses, 70,000 plus 50,000. My gross profit's now 120. I worked my way back up. Net profit plus expenses, net profit plus expenses. That would give me gross profit. I'm going in reverse order. So 120,000 is my gross profit. If I know my sales are 500,000, therefore 120,000 divided by my sales of 500,000 multiplied by 100 over 1 gives me my gross profit percent for 2005, 24%. And that's that one done. Next one here, I have these just left out because these ones were more straightforward. Net profit margin is net profit divided by sales. 2004, net profit is 60 grand. Sales are 400 grand. 60 divided by 400, 15%. 2005, net profit 70,000. Sales 500,000. 70,000 divided by 500,000, 100 over 1, 14%. So I would say most people got on very good with these here. 15 and 14 were your answers for the net profit margin. Return on investment, again, they gave you all the figures here, nice and easy. Net profit divided by capital employed. Net profit 60,000, capital employed 600,000. Therefore, 10% was my answer for 2004. Net profit 70,000, capital employed 650. It was 10.769. I'd always round up to 2 decimal places, regardless of whether they tell you to do that or not, which they didn't. So your answer here would be 10.77%. These two calculations were straightforward. What you really had to look at here was the fact that I don't have gross profit, but I know that to get gross profit, if I work my way back up, I can find it. That's that done. Okay, so I've gone through the 3 formulas for profitability. We should be okay with them. What about liquidity? So for liquidity, our current ratio is current assets is to current liabilities, and our asset test ratio is current assets minus closing stock is to current liabilities. These are, quite straightforward. So let's look at an example. Again, we'll remember the formulas. I'll come back to them in a second. I have an example here. Following information was taken into account. Find the current ratio and the asset test ratio. So current assets are 85,000, including closing stock of 15,000. Current liabilities of 35,000, sorry. I need to find firstly the current ratio. So what is the current ratio? Current assets is to current liabilities. What are my current assets? In total, 85,000. So current assets is to current liabilities. That's my formula for my current ratio. So for part 1. Okay, so what are my current assets? My current assets are 85,000. What are my current liabilities? 35,000. So here I have my ratio, 85,000 is to 35,000. That's a big number. That's not, shown in its simplest form. You always have to show it in its simplest form. So how do I show it in its simplest form? I always divide by the smaller number. So I'm going to get this is a smaller number. I'm going to get this to 1. So I'll leave that 1 alone for a second. So I want my current liabilities to be 1. And I can express this in whatever. So this is 3 is to 1, or 2 is to 1, or 5 is to 1. I want to be able to show it in its simplest form. So this here for my 85,000, if I divide 85,000, so I'm just going to write it out. 85,000 divided by 35,000 is to 35,000 divided by 35,000. What have I done? I've taken this here and I've divided both sides by the smaller number. 85,000 divided by 35,000 gives me 2.43. 35,000 divided by 35,000 divided by itself gives me 1. That's my answer. 2.43 is to 1. Okay, so this is my answer for the first one. I've worked it out. I have my current assets, I have my current liabilities, and all I did was just basically put in the figures divided by the smaller amount. Second one, okay, the second one that they ask us to get here is the quick asset test ratio. So part 2, the quick asset test ratio is going to be the same formula again, except I have to take into account closing stock. So my current assets minus closing stock is to my current liabilities. So where did I get that formula? Asset test ratio, quick ratio, current assets minus closing stock is to current liabilities. This is my second formula they asked me for. So what are my current assets? Again, they're 85,000. 85,000 euro. What's my closing stock? 15,000, and it's included here in the 85. So obviously I'm going to take this away because the formula wants me to find my current assets excluding closing stock. 85,000 minus 15,000 is to my current liabilities 35. So 60,000, just to clear it up a little bit, 60,000 is to 35,000 because obviously I've just taken away my closing stock from my current assets. How do I show this in its simplest form? Divide both sides by the smaller number. Again, the smaller number happens to be the current liabilities. It usually is. Sometimes it could be the current assets. But all you need to know is for any ratio, and I'm sure you've done this before in maths at one stage or another, that you divide by the smaller amount just to show it in its simplest form. 60,000 divided by 35,000 gives me 1.71, just shy of 2 to 1. So 1.71 is to 1. That is my answer for the second part, just to highlight that and make it some way visible. Current assets is current liabilities. There are your figures. Divide by a smaller number. That's your answer. Current assets minus closing stock is the current liabilities. There are your figures. Divide by the smaller side. There's your answer. Again, all you need to do is remember the formula, and you pretty much get full marks in any question they'd ask you because they're, it's quite straightforward. I'm going to finish up on the final ratio, which is the gearing ratio, debt to equity ratio. So gearing here, we're looking at the company itself. So for like profitability, obviously, we're looking at whether they made a profit or not, making a profit on investment or a profit for the company for the year. Liquidity is looking at cash. So we're looking at seeing how much cash they have, and I'm going to go into more detail on that soon. Now I just want to kind of go through the workings. Gearing is looking to see how much of the company is financed by debt and how much of the company is financed by equity. Equity being shares and basically profits in previous years. So what is debt? Debt is long-term liabilities, which you would have seen here in the balance sheet down here. So this is my balance sheet, my long-term liabilities, my debenture, or maybe a long-term loan or a mortgage. These are my long-term liabilities. This is my debt. Because as a business, I financed my business by taking out a 200,000 euro debenture from another company. So what we're looking at here is we're looking at seeing how much of your business is financed by debt, and why would we care? As I might have alluded to before in class, if you open up a restaurant when you walk out of school, you probably, I'm guessing, don't have much money right now. But if you were to be able to get a massive loan from somebody and open up a restaurant, your business might operate fine. You've got a loan of 200,000 euro. It's a lot of money. You get to set up a restaurant, you get to run a restaurant, it could be very successful. But behind all of that success, it looks like it's going well, but behind it all, you owe somebody 200 grand and you're paying interest, 10% interest, let's say, every year on that 200 grand. Your business is behind the scenes in a bit of trouble because it's financed mostly by debt. So obviously it's never a good idea to walk out of school, get a massive loan and set up a business straight away if you don't have any money. People do it, but it's risky. Why is it risky? Because all of your business is financed by debt, and if anything was to happen, the bank comes calling for the money or someone else comes calling for their money, and then your business is gone. So gearing ratio is looking to see how much of the money for the business you raised yourself versus, the debt that you incurred. So the debt that you incur is obviously your loan, debenture, mortgage, and I just showed you where you'd find it. Your equity capital you have to calculate. All you do is you add your ordinary shares and your retained earnings or reserves. Flicking up back here again, just going to zoom in a small bit. We can see that our equity is just below the long-term capital, long-term liabilities. Our equity capital is our ordinary shares, basically the shares that we sell. We're selling stock in our company to somebody else. That's the money that we earn. We earn that money by selling a part of the business. And we've earned retained earnings as well. This is profits that you would have made in previous years. So this is shares that you generate money from selling shares, and this is profits that you've made in previous years that you've held on to. Profits the business still has. So that's our equity. If you want to run a business and you want to take out massive amounts of loans, you're going to increase your debt. If you want to sell some shares and hold on to profits, you're increasing your equity. This is obviously much more favorable. I would prefer to run a business using profits and shares that I've sold rather than having massive amounts of debt. So this is this is the basic enough formula. I'm going to just show you a quick example. We'll finish up on this. So this is our formula, debt to equity. It's a ratio. Calculate debt to equity for this company. These are the figures: reserves, long-term loan, ordinary share capital. So if I'm going to work this out, I know that my debt to equity ratio, that's basically my debt to my equity capital. That's basically the formula itself. What's my debt? My debt is equal to my loans. So in this case, I have reserves. Reserves are profits that you've held on to, you've kept in reserve. Think of it as a form of like your piggy bank savings. That's obviously not a loan. This is obviously a long-term loan, and these are shares, you've generated money from. So which part of this is my debt? It's my long-term loan. As I said there, debts are loans, debentures are mortgages, and debentures and mortgages are basically, that's a loan for a house and that's a loan from another company. These are all loans. So my loan here is 1.4 million. So my debt here is going to be my long-term loan, which is 1,400,000. What's my equity capital? Capital is money that you raise. My equity capital is going to be equal to my reserves plus my ordinary shares. So in this case, my reserves are 260,000, ordinary shares are 440,000. So 260,000 for 40,000, giving me 700,000. Debt is 1.4 million, equity 700,000. So my debt to equity is going to be equal to 1,400,000 is to 700,000. Debt is the equity, debt is 1.4 million, equity is 700,000. So calculating the debt to equity, that's how I calculate it using these figures. I obviously want to show that in its simplest form. How do I do that? I divide both sides by the smaller amount, which in this case is going to be the 700,000. If I divide 700,000 by 700,000, I get 1. Generally, you want to obviously show this in a form where one of the sides is 1. 1.4 divided by 7 is 2. So nice and well, basic here. My answer is 2 is to 1. So if I was to work out my debt to equity ratio here, it is 2 is to 1, which is an optimal enough. It would still be considered highly geared. I'm going to get into that eventually. It would be a highly geared company because obviously out of all the money they've raised, they've double the loans as they have the equity they've raised themselves. That's all for today.